Hello, everyone. Welcome to another episode of the Tax Bite podcast series. I'm your host, Peter, and today we're diving into two major topics of European law, DAC6 and the broader developments shaping the European tax landscape. Now, a lot has been said about DAC6 in the past, but we see in the past months some renewed attention to this topic and to the potential impact this can have for you in the audience. So I wanted to take the opportunity to do a little recap of what exactly DAC6 is about, but also to shed some light on the ongoing developments in that space. And for that, I invited a number of experts in my meeting room here. First of all, Amber is here. Amber is a member of our global tax and transfer pricing team and focuses, amongst others, on DAC6. Dennis is well known to the audience. He's a frequent speaker on our international tax webinars, and I can give a little insight there. The next one is upcoming in September, so keep an eye for that one. And Dennis is, of course, here because he's monitoring very closely the European Union and US developments in the international tax space. And last but not least, I'm welcoming Bart. Bart is heading our rewards and personal tax team here in Belgium and leading our EMEA reward capability. He's also closely monitoring the Belgian tax policy developments, and I'm interested to see if there's any sign of DAC6 in those tax policy developments. So Bart, Amber, and Dennis, welcome to the podcast. And to kick off, maybe it's good that we briefly recap a little bit what DAC6 is about. And for some of the people in the audience, it could be a bit far away. It's been in place for a couple of years already. So Amber, could you give us a quick overview of DAC6? Why it was introduced, what is it, and what is the aim it tries to achieve?
Absolutely, Peter. Thank you for the introduction. To really understand DAC6, we need to rewind a bit to 2013 when the OECD launched its Base Erosion and Profit Shifting, or BEPS initiative. One of the big concerns they identified was that tax authorities simply weren't getting timely or relevant information about aggressive tax planning strategies. For example, a multinational enterprise decides to restructure a part of its business. If it happens in a certain year, the tax authorities would generally only become aware of this once the tax return on that year is filed. And by the time a potential tax audit can be initiated, the statute of limitation, in many countries around 3 to 5 years, often risks to elapse. DAC6 envisaged to resolve this by ensuring that larger restructurings are reported to the tax authorities within 30 days after, for example, the implementation. To address this, the OECD recommended mandatory disclosure rules to increase transparency. The European Union took that recommendation on board and introduced DAC6. DAC6 is actually the sixth amendment to the EU Directive on Administrative Cooperation. It requires intermediaries, think about tax advisors, lawyers, or accountants, or in some cases, the taxpayers themselves, to report certain cross-border arrangements. But not just any arrangement, only those that meet specific criteria, known as hallmarks. These hallmarks are grouped into 5 categories. Category A covers engagement-related hallmarks. Category B focuses on specific hallmarks related to M&A transactions. Category C targets certain types of cross-border transactions. Category D is all about transparency issues. And Category E deals with transfer pricing. Each category has some subcategories that zoom in on particular types of transactions. The whole idea behind DAC6 is to give tax authorities an early warning system. If they get timely information about potentially aggressive tax arrangements, they can better assess the risks, whether it's tax avoidance or abuse, and take action.
Well, thank you, Amber. So I think it's an interesting thought. So give more targeted information to the tax authorities to perform more focused tax audits and to be more quickly aware of certain transactions or arrangements that are interesting to take a look at. As such, it's a good idea, but of course, it's been in place for many years already. You mentioned the categories, the particular type of transactions. I just imagine that these are not always up to date or are changing as well. So if you look at it, Amber, in practice, and has DAC6 actually achieved this intended goal so far? And do you see a lot of reportings under DAC6 in practice?
Well, that's a good question. While DAC6 lays out a broad framework of hallmarks, in practice only a handful of hallmarks are triggered frequently. Let me walk you through some of the most common ones we see in practice. First up is hallmark B2, which deals with income inversion. This applies when income is reclassified into a different form of income, one that's taxed more favorably or sometimes not taxed at all. Then there's hallmark B3, which targets circular transactions. In these arrangements, where funds move through a series of steps but ultimately end up right back where they started, often without any real economic substance. Another frequent one is hallmark C1. This comes into play with cross-border payments between related parties, especially when the recipient is based in a low tax or no tax jurisdiction. And in the transfer pricing category, two hallmarks stand out. E2, which covers transfer of hard-to-value intangibles, think about intellectual property, and E3, which focuses on the transfer of functions, risks, and assets that lead to a significant drop in the EBIT for the transferring entity. So while DAC6 includes a wide range of hallmarks, it's in reality just a few ones that are reported most often. What's also interesting is the variation in reporting volumes across EU member states. Countries like Germany, Poland, and the Netherlands tend to have high numbers of reportings, while others have far fewer. That's largely because each country has implemented DAC6 differently. And let's not forget the administrative burden. DAC6 has introduced a significant workload for both intermediaries and taxpayers. They have to navigate through the complex rules, deal with interpretation of hallmarks, and manage their reporting obligations. So all things considered, DAC6 has definitely made progress in terms of transparency, but its overall impact remains rather limited. Why? Because only a narrow set of hallmarks are triggered in practice. The implementation differs widely across jurisdictions, and the reporting process itself is rather complex.
Well, thank you, Amber, for recapping this DAC6 legislation for us. And yeah, I definitely agree with you. If we look in practice, some of the hallmarks are rather frequently triggering reporting, maybe too often even given that category, while other categories have never triggered a reporting at all, according to me. So here the question is clearly, is DAC6, are the hallmarks still up to date? Are they still relevant for today's business? And what I've seen over the past years is that the impact of DAC6 has gradually been reduced. Is it because the hallmarks got less accurate? Are there other reasons? Who will tell? But all of a sudden, it was interesting to see that DAC6 is once again in the spotlight of the European Union. And there, Dennis, it's interesting for me to understand a bit what this is all about, what is driving this renewed attention. So from your recent follow-up on the European level, what is happening in the area of tax transparency and reporting?
Thanks, Peter. And yes, you are definitely right. The increased spotlight at EU level on DAC6 is, in my view, mainly driven by the broader tax decluttering exercise the European Commission is currently performing. In essence, this exercise is aimed at simplifying and streamlining the complex web of tax rules we currently have within the EU. And one of the elements they are looking into is indeed DAC6, particularly because the European Commission acknowledges the fact that the directive is simply very complex. At the beginning of June of this year, Hendrik Polander, who is the head of the Sector Administrative Corporation at the European Commission, he confirmed that the European Commission is reviewing each DAC6 hallmark to determine how many reportings each hallmark triggered and how many aggressive tax schemes were identified in each of the member states. Based on that review, it could be that the European Commission concludes that a couple of hallmarks are, in fact, not fit for purpose in practice. Mr. Polander also hinted at issuing non-binding guidelines to further clarify certain of the DAC6 hallmarks. Another aspect that was discussed as part of the broader tax decluttering agenda was the Unshell proposals. Various stakeholders argued that there were overlaps between the Unshell hallmarks and the DAC6 hallmarks, potentially leading to a duplicate reporting via separate IT systems. Since both the DAC6 directive and the Unshell proposal share similar goals, being the enhancement of tax transparency and the combating of tax avoidance with the EU, various stakeholders suggested that the goal of the Unshell proposal could be achieved via clarifications or perhaps amendments to certain hallmarks in DAC6. Therefore, it was decided in the ECOFIN report back, I guess it was the 20th of June 25, that the Unshell proposal would no longer be pursued as a standalone directive, but rather that it would be further analyzed whether and how the risk hallmarks from the Unshell proposal could potentially be integrated into the hallmarks of DAC6. It is likely that a decision on this topic will be part of DAC10, which is expected early 26. For the audience, I'll maybe quickly recap what the risk hallmarks of the Unshell proposals were. The first one is the absence of a managing person who is a tax resident in the member state of the entity or who lives in close proximity, and that this person is qualified and able to take key decisions. This person may also not work for more than 5 unrelated companies. So in essence, this targets the use of trust directors. Second hallmark is the absence of premises available for own use in the member state of residence. The third one is the absence of an own bank account in the EU. The fourth one is if the entity has fewer than 5 full-time equivalent employees performing the majority of their work in the member state of residence. And the last one is the majority of the meetings of the managing body, so most likely the board of directors, that those meetings take place outside the member state of residence. At this stage, it is not clear if the European Commission would include the risk hallmarks into an existing hallmark, like for example, hallmark D2, which also links into structures without substantial economic activity, albeit that this hallmark is narrower than the Unshell risk hallmarks, or whether they would make a new standalone hallmark. The latter is less expected in my view because both Germany and the Netherlands have already formally communicated in a report that they would rather prefer phasing out non-effective hallmarks and replacing them where needed with new hallmarks, but not just extending DAC6 further. In my view, this would also be more in line with the tax decluttering principles we are seeing in the context of DAC10 as well. So the current presumption is that if you meet at least one of the Unshell risk hallmarks, you would need to report. Hence, for example, for EU-based finance companies and holding companies and IP companies, which generally operate with less than 5 full-time equivalent employees locally, this would mean that you would need to report under DAC6. So it needs to be seen how this will all develop in the coming months. But as it currently stands, this could trigger a reporting obligation for a lot of multinational groups.
Yeah, wow, that is. And it's impressive how you distinguish between all the DACs, DAC6, DAC10. So really impressive, but very interesting what you told us. Eh? So effectively, if Europe is looking at extending the DAC6 directive, the hallmarks, it will be interesting to see if they will make it more qualitative or really keep the more mathematical hallmarks, I can say, or the Unshell thresholds, because that indeed could create massive reporting, massive attention. And of course, for the audience, important to know, it doesn't mean under DAC6, if you do reporting, that you actually did something wrong. In most cases, that is actually not the case. So there are a lot of perfectly legal, perfectly defendable arrangements that have been and should be reported under the hallmarks. So it's interesting to see how they will balance, I think, the workload of compliance with the effectiveness of the target of DAC6. But I don't think only the European Union seems to have found insights in DAC6 or value in DAC6. But it appears that even the Belgian legislator has renewed attention for DAC6. Maybe that's something you can explain to us.
Sure, Peter. And first of all, thank you for having me in this podcast. And indeed, from a Belgian perspective, beginning of the summer, a new draft bill with respect to the taxation of capital gains realized upon the disposal of financial assets circulated, or shortly, the so-called new capital gain tax. In this respect, for some, surprisingly, the law would foresee also to introduce a DAC6-like reporting obligation for those who are involved in relation to a transfer of, on the one hand side, a substantial shareholding, or if you were to be involved in a so-called internal capital gain tax or capital gain on shares. The reporting obligation, as you also indicated, resembles to the already existing DAC6 reporting as implemented in Belgian law. So as such, you could say, okay, why do we need another one? It aims, we think, to resolve a type of dependency of information that solely is received from the taxpayer in the context of capital gain tax. So, Peter, for instance, if I look at the existing situation, so under the current legislation, there's of course no notification duty. And for instance, you have situations where it's only the taxpayer, for instance, to one determine the qualification of the gain. So, for instance, whether or not under the current legislation, a capital gain has been realized within or without the normal management of the private estate. And then, of course, based on that interpretation, the taxpayer decides whether it's reported or not in his personal income tax return. And there, of course, the tax authorities don't have a double check or a view on all transactions. So, on the new legislation, the government intends to provide some additional tools and notification towards the tax authorities. In this respect, not in relation to the qualification, whether it qualifies within or without the normal management, but as said, under the new legislation, the reporting obligation would be introduced in two specific situations, being in relation again to that substantial shareholding, which is typically based on non-quoted shares, or again also on those internal capital gains on shares. So based on the texts that are circulating, this reporting obligation would need to be complied with no later than the last day of February, the year following the year the operation was carried out. However, we always need to speak with two words, Peter. The draft legislation still needs to go through the legislative process and is, of course, still subject to possible changes. So let's also follow up whether this notification duty will be maintained or not, but we keep you posted in this respect.
Yeah, thanks, Bart, and fully understand your comment on draft legislation. Nevertheless, interesting to see that the Belgian legislator is also looking at a DAC6-ish recipe to have more transparency and more information. So thank you for this, everyone. So interesting to see, interesting to monitor what will come in the next weeks and months in the area of DAC6 and transparency. Definitely something to keep an eye on. I thank you for the listeners for tuning in. In the next episodes of the podcast, we will dive into the future outlook of the international tax landscape, combined with the organization of our international tax webinars in the course of September. So keep an eye for that. We'll also discuss impact on tariffs and other developments in this international tax space. So keep tuned in for this podcast, and hope to see you soon in the next episode. Thank you.